Assalamualaikum warahmatullahi wabarakatuh. The purpose of this presentation is to summarize our business finance group assignment. Our group consists of six members, including me, Muhammad Shabil Afif bin Azmi, as a first presenter. So, we want to talk about the company that we have consult with our client, which is Rezeki Hibah Trending Sendirian Berhad. Okay, for the first is the nature of the business. There are three things that I want to talk about. First is types and the location of the business. Rezeki Hibah Trending is a manufacturing company that located at the Petaling Jaya, Selangor. Their type of business is they produce and manufacturing signboard, signage, and also billboard. Their service is very comprehensive, provided from correct customer preference design until the installation of the signboard. Second is the resources needed and the target customer. First, they need physical sources, which is factory facilities, machinery, printing equipment, and also the raw materials. And the second is the human resources, which is graphic designer, installation personnel, and skilled craftsmen. And for the target customer, they primarily serves local companies and small scale business including kindergartens, small and medium enterprises, malls and other similar organization. And lastly, for the key business activities, there are three, which is first is the business model. They offer the price comprehensively without hiding their customer in pricing matters, unlike the other competitors who often separate these charges in order to attract customer with their lower price offer. Second is the marketing strategy. They solely relies heavily on referrals and word of mouth from satisfied customer that they have provided the services before this. And the third is the customer base market. The company sells a lot from high end and medium clients.
Based on the interview conducted, the company faces several issues that affect its operation and growth. Firstly, the company experiences strong competitive pressure as many competitors offer lower price. However, the company avoids setting very low price because it will affect the quality and damage the customer trust. Therefore, the main challenge is balancing competitive pricing while maintaining reliability and reputation. Secondly, the business faces licensing and regulatory challenges. So it must comply with multiple requirements from different authorities, including specific license such as signboard approval. So these processes are often time consuming and may delay projects, resulting in operating losses. So next, high installation and operational costs also are a major issue. So installation requires expensive equipment such as cranes, skill labor, and high quality materials. Weather conditions also cause delays, leading to overtime costs and higher expenses. Okay, so lastly, the company faces structural limitation at customer premise. So some buildings are not suitable for installation due to weak walls of roof structure. This may increase costs, delay projects, or force the company to reject certain jobs. Overall, these issues collectively slow down operations, increase costs, and limit the company's growth.
Based on the issues we identified in the previous slide, we came up with 4 strategies to help the business grow and stay competitive. The first strategy, the company can strengthen its value-based brand positioning by highlighting transparent pricing and consistently delivering good quality product. This could help build customer trust and hence repeated businesses. Secondly, the company should have effective management of regulatory and licensing processes. This is by improving their internal coordination, which later could help address issues regarding delays in getting approvals. Thirdly, the company can apply a tiered project structuring approach by categorizing their projects based on their complexity. This could help the company to better manage their various costs and resources. Lastly, the company could adopt a flexible project execution. This could allow the company to better manage any unexpected issues during installation. So by having flexibility in timing or in the method used, the projects can be completed more smoothly.
So next, I will be explaining about the cost of capital. So in order for us to calculate the WACC rate, we managed to get most of the relevant information that used in the formula. For example, for bank loan, the interest paid by the company is 5% and the corporate tax paid by the company is 80%. Next, for the common stock, the value of the common stock is 1 ringgit. And the dividend as well as the constant growth rate, we couldn't manage to get the exact figure due to the company's policy, which is they treated these two information as private and confidential. So we have to assume based on the usual amount adopted by other companies that run in the same business as this company does. So we assume that the company paid dividend up to 8%, and the constant growth rate per year is 10%. Last but not least, for the weightage average for each financial instrument, bank loan is 70%, and for the common stock is 30%. And then all this information, we put it together in one formula, and then finally we got the WACC rate, which is 8.27%. So why this figure is very important? It tells us the minimum rate that the company should get in any new investment. If the company is planning to invest in a new project, they must consider the return rate of the project itself. The return rate must be equal or more than 8.27%, which means the project must at least cover the financing costs that the company has to bear in order to start the project. If the company earn less, it indicates that the company is effectively losing value for their founders and shareholders. Moreover, the WACC rate also measures the financial risk of a company. If a company has low WACC, if the company has high WACC rate, it indicates that the company is very risky and insufficient due to high financing. On the other hand, when the company has low WACC rate, it emphasizes that the company has cheaper financing and lower risk to pay all the debts to shareholders.
We move on to the next part, which is calculating the forecasted cash flow of the company. The company want to expand its product by making a high quality and valuable reward in order to boosting their sales. And these new products will be marketed to high-end or luxury companies. In order to make a high quality and valuable reward, they need to purchase a new machinery equipment with price of 350,000 ringgit. And there are others collected information regarding to forecasted cash flow, as you can see on the slides. So this is the 5-year forecasted cash flow of the company. As you can see, the increase in net working capital is the current asset minus with the current liabilities. And as for the sales, we estimate that for the first year, the company will get 800,000 ringgit and it will increase by 10% each year. And for the operating costs, we excluded the depreciation, and it also will increase 10% each year. For the tax rate, we estimate that the company will have 30% tax rate. As you can see, this is the statement of profit or loss of the company, and most of the items here are fully estimated with the value, but we have already reconciled it with others billboard company. So this is the statement of financial position for the company, and we also have estimated the value, but we have used reasonable and logical data for the billboard company.
For the cash flow results, the project requires an initial investment of 365,000 ringgit at year 0, which includes the cost of machinery and net working capital. From year 1 to year 5, the project generates increasing annual cash flows starting from 791,500 ringgit in year 1 and rising up to 1.17 million in year 5. This significant increase is mainly due to the assumption of 10% annual growth in sales. To value the business, we apply the discounted cash flow income approach using the project's WACC of 8.27% as the discount rate. The net present value of the project is 3.79 million, which is positive. This indicates that the present value of future cash flows exceed the initial investment and the project creates value for the business. While the payback period is approximately 0.46 years or about 6 months, showing that the initial investment can be recovered very quickly, indicating high liquidity and low risk. The initial rate of return is 226%, which is significantly higher than the WACC of 8.27%. This shows that the project has strong profitability. The unusually high IRR is mainly due to the relatively low initial investment compared to the large cash inflows generated in the early years. Since the business is expected to continue beyond year 5, a terminal value was calculated using the Gordon Group model with a long-term growth rate of 4%. The present value of terminal value is 19.13 million, which represents the value of future cash flows after year 5. Overall, based on the positive NPV, IRR exceeding WACC, and short payback periods, the project is profitable and is recommended that company proceeds with investment.
Okay, for the recommendations, we have calculated that our discounted cash flow analysis confirm that this project is a good investment with a positive net present value of nearly 3.8 million. The investment is set to generate significant value. To ensure success, our strategy focuses on two phases, which is first, the business will maintain a 4% long-term growth rate by keeping operation lean and quality high. And for the second, is they can plan to reinvest their early profits back into the business by upgrading their tech and expanding capacity so they can grow without heavy external loans. Finally, they will stay agile by regularly monitoring their return of investment and diversifying their revenue to mitigate market risk. So, in short, this project is profitable, self-sustaining, and also ready for implementation.